Investors, there is a company whose stock price plummeted nearly 30% on its first day of listing. It's not a tech company, nor is it a biotech firm. It's a private education company from Singapore that provides swimming instruction. The name of this company is Fitness Champs Holdings. However, the way this company went public was more complicated than most tech IPOs, and it raised more questions than many speculative ventures. These questions go far beyond just numbers. They concern structure, intention, and the very direction of the company itself. Fitness Champs Holdings was founded in 2012. It has long provided professional swimming and water safety education across Singapore, with contracts in both the government sector and private market. What they offer isn't just recreational swimming classes. They're one of the service providers for Swim Safer, a national program run by the Singapore Ministry of Education to ensure public water safety. As of 2023, the company reportedly handled about 30% of total scheduled assessments for this program. This suggests Fitness Champs Holdings was the dominant player in its sector. So why did this company choose to go public on the US Nasdaq exchange? Why did a business headquartered in Singapore suddenly create a Cayman Islands holding company and list that entity instead? This structure is unusual. Ordinarily, companies list through an entity that directly controls the operating business, often located in the same jurisdiction. At minimum, the listing entity has a clear and direct ownership of the operational core. But Fitness Champs Holdings created a Cayman Islands holding company, essentially a paper entity in a tax haven, which, through an intermediate company in the British Virgin Islands, controls the two operating subsidiaries in Singapore. As a result, investors who buy shares on the market are not purchasing equity in the actual operating companies generating cash flow. Instead, they are acquiring indirect ownership in a legal structure far removed from the business's core. And this is where the mystery begins. Why would a company with revenue and customer traction adopt such a complex and indirect architecture? The answer for investors is deeply troubling. This structural disconnect means that shareholders have no legal claim on the real operations. They cannot directly influence financial management or governance, leaving them in a fundamentally powerless position. This disconnect also revealed itself in the IPO process. The company offered 3,750,000 shares. 2,000 of these were newly issued shares by the company, but 1,750,000 shares were secondary, sold by existing shareholders simultaneously with the IPO. Typically, during an IPO,